So, unless you are one of the lucky few that can pay cash for a home, if you're thinking of buying a home, you're probably going to need to get a loan. Well, what does that look like? What is involved and what are the first steps that you need to take? Well, that's what we're going to talk about today. Hi, my name is Carol Darrow, and on this channel, I talk about everything that you need to know about living in Lake Havasu City, including what you need to know about buying or selling a house. And if you have an investment property, what you need to know about renting out your home. So let's get started. One of the key components to buying a house is getting a loan, and the lending industry changes daily. So I've invited one of the top lenders in Lake Havasu, actually the top lender in Lake Havasu, to join us today. Thank you for joining us, Dara.
Thank you for having me.
Dara is the office manager and loan officer for a local mortgage company here in town called High Tech Mortgage. So Dara, thank you for joining us today, and I am really excited to hear about what you have to share with us. But first, will you tell us a little bit about yourself?
Of course. So my name's Dara Paddock, and I'm from High Tech Mortgage. I'm the branch manager, the broker, and a producing loan officer. High Tech Mortgage is the #1 lender in Lake Havasu City. We've been the longest running company. We've been on Main Street for 20 years in a row.
Wow.
And today is actually my 8-year anniversary with the company, and I've been in the business for 10 years.
Well, congratulations.
Thank
That's
you.
saying something.
So the first thing I want to talk about is occupancy. There are actually 3 types of occupancy when applying for a home loan or a mortgage. Mortgage fraud is actually investigated by the FBI, so we do take it very seriously. And occupancy fraud is the #1 type of mortgage fraud. So the first type of occupancy is obviously your primary residence.
Right.
Your primary residence is considered where you live and where you work. So your primary residence has to be located within a 50-mile radius of where you work. There's certain circumstances where you can work outside of that, like for example, if you've already been making a commute, then you're going to buy a house that's over 50 miles away from your employment. You're going to continue making a commute. Or if you are a firefighter or a nurse where you work longer hours and you stay at the station. So there are exceptions to the rule. But in most cases, your primary residence is considered where you live and where you work. And when you buy a home as a primary residence, you can put the least amount of money down for down payment, and you intend to occupy that property right away. The second type of occupancy would be a second home or a vacation home. And this comes a little bit confusing because when we call it a second home, it's not necessarily the second home that you buy. It's a vacation home. You and your family are going to occupy the property for vacations.
I can see why that would confuse people.
Yeah, so some people, there's a misunderstanding where the first home you buy has to be your primary residence. But if you live and work in California and you rent a place there, the first home that you finance or the first home that you buy wouldn't necessarily be a primary residence. It would be a second home or a vacation home. And the intent with a vacation home is that you and your family are going to recreate at the home for, less than half the year.
Okay, good.
The third type of occupancy would be a rental property or an investment property.
Okay.
And it would be just that. Your intent would be to put a tenant or a renter in there right away, either full-time or part-time. Now, the down payment on a rental property is typically the highest requirement. It's either 20 or 25% down, depending on how many units there are, if it's a duplex, triplex, fourplex, or just a single family home. And the interest rate is typically just a little bit higher on an investment property because it's the biggest risk for the lender.
Oh, okay. So Dara, I get asked all the time what the interest rate is. And I'm not a lender, so I really don't know how to answer that properly. How would you answer that?
So what I can share about interest rates is that they are ever changing, and there are about 38 different factors that determine what your individual interest rate would be. You know, it depends on if you're doing a first-time home buyer program. It depends on if you have a second home or an investment property. It depends how much you're putting down. It depends on if the property's a condo or single-family home. So
Okay. That might be a great topic for another video.
So what I can tell you about interest rates today is that they are heading up. We have two big changes coming down the pipeline. The first is it used to be that interest rates were relatively the same for a primary residence and a vacation home.
Okay.
So if your interest rate was 3.5% for your primary, it was very close to 3.5% for your vacation home. And then you're anywhere from a half a point to a full point higher. So maybe 4% to 4.5% on an investment property. Well, a couple weeks ago, the FHFA, which is the governing body that keeps a watch on all of us loan officers, they announced that interest rates for second homes were going to be going up, and it's going to probably come into effect sometime in February. So basically, the interest rate for a second home is going to be closer to the interest rate for an investment property, meaning the interest rates on second homes are going up significantly, a half a point to a point higher than primary residence, and it's making it more expensive to finance your vacation home.
And Havasu being a vacation destination and second homes are...
It's going to cause a big impact.
Hey, what do you think of this video so far? If you find this content valuable, go ahead right now and give me a thumbs up.
The second change that's coming is it's no secret, it's all over the news that interest rates are heading up. They actually started to increase in the beginning of December, and they went up at least a quarter point in December, and then they've basically been going up every single day since the beginning of the year.
Every day?
Every single day, sometimes multiple times a day. So we just sit and watch the market deteriorate. So if you are thinking about financing a home and you're on the fence, I would do it as soon as possible because rates in general as a whole are increasing rapidly.
Wow. So we've really been spoiled with low interest rates for a really long time.
We have. And they're still low. If you think about the scheme of things, interest rates were 10, 12, 18% when my parents were financing their first home. We're not even at 4% yet. So they are still low. Don't let me fool you.
But it's going up.
It's going up.
So Dara, when you go to get a loan, what is the first step? What do you look at first?
So basically the process is very simple. It's a basic math equation. So we'll start by having a conversation. I'm going to get your personal information, enough to pull a credit report, and I'm going to get your monthly income breakdown, where it comes from, how long you've been receiving it, how much is it. Then I will pull a credit report and we'll calculate your debt to income ratio, and that tells us exactly how much monthly mortgage payment you qualify for.
Okay.
Then we work backwards and we figure out what that equates to in purchase power.
Okay. So it's not just how much you make, but it's how much you make
versus how much you spend.
Subtract how much you spend.
On your credit report, how much you have financed.
Okay. So Dara, how does that work?
So basically, we take your monthly income, we cut it in half, and then we deduct the minimum monthly payments from your credit report and any taxes, insurance, HOA dues on any other properties that you own.
Okay.
So it's a basic math equation. Whatever the leftover number is at the very bottom, that's the amount of mortgage payment that you qualify for.
Okay.
So for example, easy math. If you make $5,000 a month and your total monthly debt on your credit report and any other properties you own is $1,000, it's going to work like this. We take $5,000, we cut it in half to $2,500, we deduct the $1,000 of monthly payments that you have, and whatever's left over, $1,500, that's the mortgage payment that you qualify for.
Oh, okay. So that's interesting. Why do they cut it in half?
So Fannie Mae and Freddie Mac, they allow you half of your income to cover anything financed on your credit report and any housing expense such as a mortgage payment, property taxes, homeowners insurance, and HOA dues. Then they allow you the other half of your income to cover expenditures such as gas, groceries, insurance, utilities. So,
well, that makes sense. You need to be able to live, not just pay your house payment.
Right. And again, with self-employed borrowers, it gets tricky because we're only allowed to give you credit for the income that you pay tax on, your taxable income. So we get further into that in another episode.
Definitely. Well, Dara, that was incredibly useful information and very insightful. I appreciate you coming very much today. And we will definitely have a couple other videos and go into a little more detail on some other topics that we didn't quite get into today. But I will be sure to put Dara's phone number, email, and website information in the comments below. So do not hesitate to call her if you have any questions.
Thank you so much for having me.
Oh, I'm glad you came. Thank you so much. Well, I hope you found this video helpful and hopefully you learned something from it. I will definitely put Dara's information below and contact her directly with any questions that you have. I know Dara, I have used her personally for my financing of my loans, and she's fantastic, and she is always so quick to answer my questions and get back to any of my clients. So I am so grateful that she joined us today, and I hope you had a great time. We'll see you next week.